the great divide like few have seen before. Some of Wall Street's leading economists, strategists, and top money managers are split on whether the Federal Reserve will raise interest rates when it wraps up its two-day meeting tomorrow. And the latest economic data may complicate things even further. Consumer prices unexpectedly fell 0.1% in August as gasoline prices declined, and that's the first drop in that index since January. But inflation is something the Federal Reserve wants to see more of, not less, making what happens tomorrow anybody's guess. Steve Leisman reports.
Set, down, hike. For the first time in the 5-year history of the CNBC Fed survey, a plurality of respondents forecast the central bank will raise rates at the current meeting. Despite harrowing market volatility and rising anxiety over global growth, 49% see the Fed hiking rates this month. Of the 51 economists, money managers, and strategists who responded, 43% say the first hike will come later, with 8% unsure.
We think the Fed will hike, although it's obviously a very close call. But they'll try to soften the blow by talking about a very slow exit going forward. Whatever the Fed does, they do not want to create a serious shock into the capital markets.
Indeed, estimates for the Fed funds rate are just 37 basis points for the end of the year and a little under 1.2% next year. That suggests Wall Street sees the Fed hiking very gradually. But there are concerns. The probability of a recession rose to nearly 19%. The third straight monthly gain and the highest in 3 years, though still relatively low. And the number one global threat? Overseas economic weakness. It's the reason most likely cited for the Fed doing nothing. Still, several analysts insist the market is ready for a rise.
We've had $46 billion come out of equity mutual funds, and we've shaved off $5.3 trillion in global equity valuations. Part of that has to do with a concern over a slowdown in China, and certainly part of that has to do with an assumption that the Fed is going to do something sooner rather than later.
Opponents of the hike say wages aren't rising, inflation is low, the recovery is tentative, and global economic weakness promises to hurt the U.S. economy. Instead of a hike, they think it's best for the Federal Reserve to call a timeout on raising rates. For Nightly Business Report, I'm Steve Leisman.